This is Chris from thetraderguy.com taking a look at major currency pairs in the European region. The first thing I'll look at is the 10-year yield in the United States, which closed at 4.763% on Friday, and breaking above the 4.75% was a big deal. This opens up the very real possibility of the 10-year in America hitting 5%. This, of course, attracts more attention and more money flowing into the US as inflation is an issue and prices should inflate. Think of it this way. If you own a bunch of Swiss francs or Japanese yen and have to deploy capital into the markets, it makes a lot of sense to send it somewhere where asset prices are going to be inflating, and on top of that, you get currency appreciation. That being said, it is worth noting that the United Kingdom has seen interest rates skyrocket as well, but that has had the opposite effect on the British pound, as it's more about the concerns of a fiscal policy or perhaps maybe a lack of. So, in that backdrop, let's take a look at the three major European currency pairs. The euro, of course, fell during the trading session on Friday pretty significantly, testing at one point the 1.02 level before bouncing a bit. But at this point, I really don't see anything that will keep this market from finding parity. At this time, I am looking at parity as a very real target. Short-term rallies, I think, run into a lot of trouble at 1.04 and 1.0450. If we see a bounce to that area and any signs of exhaustion, I have no hesitation whatsoever in starting to sell the euro again. In fact, I have zero interest in owning the euro against just about everything else. The British pound, of course, as I mentioned, has higher rates than many other currencies, but unfortunately that's because there are major concerns about the government's budget. You can see that the British pound fell just below the 1.22 level at the end of the day on Friday, and I see nothing that's going to keep this from hitting 1.21. Again, though, I would rather see a short-term bounce that I could start selling into at the first signs of exhaustion, so I may very well play that trade. I'd be particularly interested in shorting the British pound at 1.2350, and if for some reason we bounce to the 1.25 level, I'd be interested there as well. The US dollar against the Swiss franc is a pair that I've been trading quite actively over the last couple of months, buying US dollars every time it dips. The problem, of course, with that is that it hasn't dipped very often. The 0.92 level offers a significant short-term barrier that has been playing out over the course of about 14 months. And now we have to see whether or not we can break above there on at least the daily close. And I would probably even give it 50 extra pips. So in other words, I want to see the US dollar close at 0.9250 or higher. In that environment, I anticipate a move to the 0.9450 level, followed by the 0.95 level. Anything above there, I just see nothing but empty air between that level and parity. If we do get a pullback, I won't hesitate to buy at 0.91, 0.90, and 0.89. The catch, of course, is anytime the dollar pulls back, I'm looking to buy it, but I want to see that V-shaped pattern. I want to see the market bounce back in favor of the US dollar, so I know that at least momentum is shifting back towards the trend. This is a vital level of resistance in the US dollar Swiss franc pair. I suspect these pairs will all make the same move at the same time. This is all about weakness in Europe and strength in the United States. The Swiss franc is particularly in trouble due to the fact that the Swiss National Bank cut interest rates by 50 basis points recently instead of a projected 25. While it doesn't sound like much, it's double. Why did they do it? Well, they had to do it because of the European economy. 85% of Swiss exports end up in the European Union. Ultimately, I do think that the US dollar continues to strengthen, especially now that we get CPI and retail sales number this week, which will probably only continue the US dollar strength story as inflationary pressures continue. My name's Christopher Lewis. I run thetraderguide.com. Come see my website and sign up for the free newsletter that will give you my insights and what I'm looking into in financial markets globally.